Checking to see if you can hear me. All right, folks, we are going to get started here. Welcome. I've got a lot of interest this quarter with the presentation, so should be some good stuff. Not going to be too long today. So what I hope you could do is find the Q&A button in the upper right-hand corner, and any questions you have, we'll tackle at the end of the presentation here. But we do love questions, and so consider it. But yep, we want to keep everybody up to date. We've done a couple this year, so this is the third quarter update. So let's jump on into this thing here. Okay, so this third quarter has been pretty good. The market has been extraordinarily resilient in the face of all different types of obstacles, so to speak. And everything kind of started early in the year when the tariff Liberation Day began, and we saw some pretty significant volatility for a while there. Things cleaned up a lot quicker than we thought they would, and we've moved in a healthy way. In fact, the third quarter has been led primarily by artificial intelligence, everything that is involved around that, the technology, the computing, the energy, has really been booming things. Also, the expectation that the Fed will continue to lower rates has helped as well. So, companies like in the Magnificent Seven, such as Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, we've seen really good runs on that as well. So the third quarter with the S&P 500, you can see here, had a 7.79% return, and the Dow Jones did 5.2%. 2%. That brings the year-to-date earnings on these indexes. The S&P is up about 14%, while the Dow Jones is closer to 9%. So we've seen a really good rally, especially again when you consider the type of deterioration we had in March and April. The market was down as much as 19% early in the year, which really spooked obviously a lot of folks. That required us to get a little bit more protective with the portfolios and then eventually move our way back into the system. So what are we really looking at the front here? So when we look at inflation, it has certainly stabilized in contrast to past years. It got as low as 2.6%, you can see in April, and has bumped up a smidge since that point. So we're still a little bit above where the Fed wants to see us, really shooting for a 2% core inflation rate. And that's kind of what's been driving the lack of interest rate decreases is inflation. And so it certainly has stabilized compared to the past, but we still have it here. The tariffs probably are going to continue to add to that as we see it. But this is a good description of what we've seen with interest rates. So the Fed has been very quiet for most of the year. You can see for the first 5 meetings, there were no changes in the interest rates. But in September, they did change their tune a little bit and they decreased rates to be in a target range of anywhere from 4 to 4.25%. So the stock market did react positively to this, as you could see with the type of returns we had in the third quarter. There are 2 more meetings scheduled, so today and tomorrow, and then another series at the beginning of December. So there have been whispers of potentially 2 more rate cuts. We will see. Well, I don't really have much to comment beyond that, but we will see. So if you have questions about that, fine in, and I'll kind of touch on it at the end of the year. Excuse me, the end of the presentation here. So bonds, we look at where rates are right now in contrast to where they were in January and where they were in June. So rates have certainly come down a smidge, and that is partially to do with the anticipation that the Fed is going to be lowering rates. We do find that the bond market moves in front of the ahead of the Fed, and so we've seen rates falling in a pretty aggressive manner across the board. And so I want to say I saw too that recent mortgage rates were down to the low 6s. So for individuals that are in the housing market, that type of thing, it could be a good opportunity to look and see if there's savings available to you there. But bonds are a key component to the portfolios. We generally utilize these for people that are on the say the back 9 of retirement planning. When you're younger, it's not as necessary to have these types of instruments. Some people have it because they have a need for safety, but normally when you're younger, you want to kind of stick through it, continue through the market, and go through there. But with the bonds, they become a pretty core position with our more senior clients, and so where rates are have a big impact. Now, when rates go down, you will find that the value of your bonds will go up. So we've seen a nice little click on that front. But again, the interest on a going forward basis will suffer a smidge. So we're definitely keeping an eye on that. As we look at money market rates, CDs, and things along those lines, if you're sort of asleep at the wheel, the banks are not going to reward you in consideration of where rates are at right now. And so money market rates, you can see, will be at 56 basis points. You can find them higher if you talk to your bank. If you look at firms like us, we can find much higher rates than that. CDs are definitely dipping down. This is just a core from the bankrate.com, the 1.96, but certainly you can find higher rates than that where we are. But you can see that the Fed fund rates from a year ago has dropped quite substantially from where we're at. So a big topic of conversation that we have as people are seeing their CDs come due and they're not getting quite the interest rates that they were getting. In some cases, pretty substantial drops. I actually met with a client yesterday where they just let their CD roll and it went from a 5% to a 1.5%. So if you're not actively involved, the banks can sometimes take advantage of that. Now, there are things to keep in mind. There are other ways to get good interest rates. Treasury bonds is something to consider. With a treasury bond in the state of California here with a very high tax rate, you don't pay state taxes on a treasury bond. So you can find short-term bonds, 3 months, 6 months, just like you can with CDs. So those are areas that we can help you out on. And also the fact that you wouldn't pay a state tax on a treasury bond is an advantage as well. Municipal bonds take it a whole nother level. A national municipal bond, you don't pay any federal taxes on, whereas a state of California municipal bond, you would pay no federal or state taxes. Now, every state has different rules and guidelines. So if you live out of state, we can look and see what is available. But for people with short-term money, we have been seeing some moves more into treasury bonds and even municipal bonds, depending on where the situation takes you. So keep that in mind when you need to park some safe money. So now let's look ahead, in consideration of what has happened in the past, and we'll look at the average returns for the S&P 500 since the 1950s. The first and second quarters have been pretty good. They average roughly around 2%. The third quarter is always the roughest, so we're coming off a pretty good third quarter here, which is a little bit outside of what we've normally historically experienced. The fourth quarter, though, traditionally is the best quarter for performance. You can see here on average, it averages about 4.2%. Right now, we are seeing a good move in this fourth quarter here. The stock market continues to move along. We've had a little bit of volatility over the past few weeks, but continues to set new highs and move on that way. Again, mainly driven by AI and the technology sector right now. So for anybody that's young, this is particularly important for those that are in 401k plans, our participants on that front. It can be a little bit unnerving when you see what the markets do and things along those lines on a short-term basis. But over the long term, you can see here the arrow goes up. And as long as capitalism is still working here in the United States, I would expect the stock market is going to continue to move in a positive manner. You look at the pink lines, 10 years, the blue lines, 20 years, 30 years for the purple, and 40 years for the green line here. It's the same trend line across the board. And you're going to see some pretty significant dips in there at times. And as you're going through them, they're not pleasant. But for people with a long-term time horizon, equities is certainly a place to consider. So some takeaways from this presentation is equities did reach record highs in the third quarter. Again, September, we did get a rate cut, and potentially we may get one more in the next 2 days and potentially in December. Inflation has been relatively stagnant, hasn't gotten all the way down to where the Fed would like them to be, but it's there. I am concerned. I see a red. Can you guys hear me? It says my microphone is off, and it gives me it makes me nervous. Okay. Well, the Zoom here shows that my microphone is off. And that would be just a big waste of time if you guys are all paying attention here. But good, I'm glad you guys can hear me. And then lastly, bonds experienced a little bit of volatility during the third quarter as the Fed was determining if they were going to raise rates or lower rates, and ultimately wound up lowering rates. So again, on a going forward basis, we're fairly optimistic about the fourth quarter. It seems to be playing true to form right now. Again, we're always going to be concerned about headwinds. And so there are a lot of things that are going on. The tariff battle with China has been taken to a whole nother level. Trump is in Japan today, from what I saw, and potentially there could be a meeting with the Chinese premier. There's been indicators that goes on there. So we'll see some volatility there. AI, while it's helping stock market returns, is affecting folks from an employment standpoint. So that is going to be something to look at as well. And then again, the ongoing constant battle of the government shutdown is something that we're keeping an eye on. So we're looking at things. We do continue to take a very active approach to our management style here. But again, remember, always stay focused on your long-term goals. There are a lot of solutions out there if you're feeling the nerves, if you're feeling issues. So just give us a call. Even after this meeting, send us an email and a call. But I'm really hoping I get some really good questions this presentation here. So this is our compliance. So make sure you memorize this. Take a screenshot of it. Read it 28 times. I'm going to leave it up a little bit here because in the past, sometimes I've moved it off too quickly and gotten my hand slapped by LPL. So that is kind of a wrap. I just cannot reiterate enough that we certainly appreciate you. Don't keep us a secret. If you know anybody that could use our assistance, uh, we'd always happy to help out. So keep that in mind. But I am going to look and see if anybody was able to ask some questions. I'm a little bit excited here. Okay, I've got some I could hear you. Thank you for that. Someone just asked a question. If you had a question, what would it be? Okay. Well, if you have something a little bit more personalized, just drop me an email or phone call, or you can even text me on the new business line as well. And so if you have any questions, hit me up on that front, and we'll be back. We're going to be doing another one of these on Thursday. If you found it even a degree helpful, be sure to invite your friends and family. Um, I do have a question here. So, individual said they moved their portfolio a little bit more conservative and wants to know if they should move it back. So, that's going to be a tough question to ask for a general audience here because it's going to be specific to you and kind of what's going on with your goals and situations and such. So I would say for that one, I will reach out to you directly, and then we can have a conversation about that. In general terms, how we would want to look at it is you figure out what type of risk tolerance you can withstand in consideration of your retirement goals. And generally, you kind of want to try and ride through that. The problem we run into with folks that if you do move more conservative and maybe the time isn't right for that, the market continues to go up. Now it becomes more difficult to get back into the market. What it could be is that we rebalance your portfolio to such where you have a degree of risk and some conservative and something that maybe is a little bit more palatable to ride through. So, but I'll reach out to you directly to kind of talk about your portfolio for the individual that asked us that. I appreciate it. I like questions. So that is a wrap. I will see you next time. And of course, if you have anything, just reach out to us. Thank you all again. Have a great one.